Hey, welcome back. With the recent earnings report disappointing the market and the stock crashing, WBD is now at pretty much the lowest levels in history, but as you are about to see, I don't think this is too justified. The main headline was the huge 10 billion loss that they posted in Q2. 9.1 billion of that was in goodwill impairments related to cable TV and 2.1 billion was in amortization, fair value adjustments and restructuring expenses. The sports rights renewals had a pretty big impact, and the thing I want to mention is that the stock already crashed when the news about the NBA came. Anyway, Max is now available in Europe and we can see a 20% year-over-year increase in international or 10% versus Q1. They see the direct-to-consumer segment turning profitable in the second half of the year, which has potential to at least offset the decrease in cable for now. Despite the 10 billion loss, the free cash flow was almost 1 billion during the quarter, which is still pretty impressive. That brings the total during the last 12 months to around 6.7 billion, which is very good for this market cap. We'll see if they keep making a lot in the second half of the year as they did before. The movies can be pretty volatile, so I think they should make something in the range of 5 to 7 billion on average. Still, with Max potentially becoming profitable in the second half, plus the elections boosting cable TV and some potentially big movies coming soon, this can be another great year. Now, you might be wondering how the cash flow can be so high when the company has a deeply negative net income. That's because of the way the net income is calculated, which is the reason why I prefer the free cash flow in most cases. Again, they took out around 9.4 billion in goodwill and other impairments, but that has no effect on the money they made or had to pay. Goodwill is a pretty worthless asset anyway, which they got as a result of the merger, and you normally see me take it out of the equity when looking at a company's balance sheet. Now, in pretty much every quarter, we can see very high depreciation and amortization plus impairments. Simply put, the assets and many of the things they used and got from making The Hobbit, for example, a decade ago, can still generate amortization today. The role of depreciation and amortization is to lower the net income over a longer period so that you pay less taxes and make it a more linear benefit rather than posting a huge loss once and that's it, which would be a waste. Anyway, the amortization will decrease in the future unless they do some huge movies that will generate even more, and the net income should get positive in a few years. Financially, we can see that the current assets don't cover the current liabilities, meaning that they might have to access the credit line depending on the timing of the cash flow, payables and receivables. Still, there are overall enough assets to offset the liabilities, and even after taking the goodwill out, there is about 10 billion in equity. They need about 2 billion in interest expenses, so if they make 4, 5, 6 billion, they should be able to repay a lot of the debt and reduce the interest. They recently bought back 2.6 billion of the debt in a tender offer which they increased from 2.5 billion. The debt is still high and that's probably the main issue with the company, but they are focused on reducing it significantly in the future. Then, when they free up some capital, they can focus on dividends, buybacks and so on. Even a 10-20% payout for such a high cash flow would be huge on this market cap. I want to briefly mention the effect of upcoming rate cuts. Something like 99.8% of WBD's debt is fixed, so they don't really care about those changes, but if they want to refinance, the lower it is, the better. Still, I think the effect is overall positive, especially since they would be beneficial for the economy. You know, a company with the kind of issues that would justify such a price would probably issue more instead of increasing the offer to repay. Again, this is how the net income can be misleading. I generally prefer the free cash flow, especially for this reason. There was some recent news about them looking into a potential restructuring or spin-off or merger or anything that would unlock some value. I mean, they probably don't need it in the long term if they keep reducing the debt and expanding Max, but it could be a way to gain some attention from the market. And this kind of taps into the idea that I keep mentioning about the value of their IPs. A company like Amazon would barely feel the dilution even if they paid 100 billion for Warner Bros, but they could develop what they have so much that it might be worth it. You know, rather than paying 2, 3, 400 million to get rights for series which become more and more limited and expensive, this way they secure content for life. It would fit Amazon, especially with the gaming studios as well, so it could eventually become a reality. You know, even 100 billion enterprise value for a company making over 6 billion is a ratio below 20, so still very good. Sure, they don't own the Lord of the Rings franchise, for example, but the DC universe alone has a ton of potential. We saw what the Joker movie did a few years ago, and that was one movie about one character, soon two, from a potentially infinite universe. If they do it right, this can become what Marvel was 10 years ago when it was successful. Add the potential series and games that they can make, plus the iconic characters that can be used or licensed for other things, and you can see how a company like Amazon can really benefit from this. You know, they could also buy just a part of WBD, they probably don't want a cable company. If they split Max, the gaming studios and the IPs from the cable business and a big chunk of the debt, this new company can be really attractive for a potential buyer and especially the market. And the thing is, they don't even need another company to buy them. At this rate, even with zero growth, in half a decade the balance sheet will be much better and then they can easily pay some 10-15% dividends and buybacks. You know, if they pay back the debt and develop out of cable, I don't think the market would have an excuse to keep ignoring them. I saw and I keep seeing even now the classic dividend investors that got WBD out of their AT&T selling this, especially after it fell so much. I have some AT&T as well, and back in the day before I invested, a main attraction for me was actually what they spun off, meaning WB. We had this shift in ownership ever since the spin-off. You know, it's people that probably don't look into it, see a negative net income and most importantly, no dividend. This kind of company doesn't fit every portfolio. If this is your retirement portfolio and you depend on those dividends to live, you can't wait half a decade to maybe see a dividend from this. In the future, if they pay a dividend and the price probably doubles or triples or more, this kind of people might be back, but now I think this is at a stage where it's attractive mostly for value investors. And you probably know that we aren't that many. So when you have so much constant selling pressure and basically no coverage from the market because everyone sees you as a way for AT&T to clean the balance sheet a bit, you can see how the price can fall so much despite the company improving. By the way, I'm now a Moomoo affiliate and they have some really nice sign-up bonuses and the overall platform is very competitive. You can get up to 15 free shares depending on how much you deposit, plus a very attractive interest on the uninvested cash, so if you're interested, check out the links below to see if you're eligible. It's a nice way to support the channel while also getting some benefits. Again, I'm not going to sell you some courses or anything like that. They were a very prominent sponsor at the Olympics, which tied very well with the expansion in Europe. Again, a company that the market sees as having huge issues, getting such a spot in this kind of event or really having money for any spot at all contradicts the market's opinion. If they were in the kind of distress that would warrant such a price, they couldn't even think about repaying so much debt or sponsoring the Olympics. But generally, the market doesn't think that much about the sustainability of the debt and just takes it as an absolute number. I think the valuation is pretty simple to do. In a bad scenario with Max not working and cable TV falling, they can probably still make around 2.5 to 3 billion. That's basically what Discovery alone was making before the merger, so it would be a huge decrease. That's not enough to pay the interest and the current debt, so they might need to refinance over and over and just pay a very small amount of the debt. Anyway, if the market continues to trade them at a ratio of around 4, that's a market cap of 11 billion, meaning a price of 4.48, so a 30-something% loss. But to get to this scenario, they would need to really mess it up, which given the big bundles and deals they have with giants like Disney, I think it's very hard to see. And if they fall to this level, it wouldn't be impossible to see a company like Disney or Amazon just buy them. Now, in a second scenario, if they keep it up the way they do now, let's say they make 5 billion per year. If they can make that much and they keep focusing on the debt, this can rapidly improve. Assume a ratio of only 8 and that's a market cap of 40 billion, meaning a price of 16.29. That's close to a 2.5x, which is already very good. Add the potential to easily pay some 6 to 8% dividends and some buybacks and you can see how this can do well. In a good scenario, let's say everything goes okay with Max and cable TV isn't doing that bad and they manage to make 7 billion somewhat consistently. That's Netflix levels of cash flow, by the way. And by the way, Warner Bros. Has a slightly higher revenue than Netflix. For a ratio of only 12, which is pretty low in the industry, especially if they pay back a significant amount of debt, that's a market cap of 84 billion. That means a price of 34.22, meaning roughly a 5x. I think if they focus on the debt and pay like 4 or 5 billion per year in this scenario, the market will inevitably have to pay attention to it, because otherwise that 4 billion going into dividends or buybacks means a 25% yield. Sure, it can be better or worse, this is at the end of the day just a simple what if scenario, but I think it gives a pretty good idea about the potential upside and downside. So overall this is a clear buy for me, and I actually started buying a couple of months ago. I kept buying this especially below 8, but I still want to develop the position, so I'm not very happy to see it go up. Still, I think anything below 10, maybe 12 should be very good and it would offer a lot of potential. The company is actually developing, and with the expansion of Max in Europe and the potential spin-off or acquisition and so on, the risk reward is very good for me. They can make a ton of money, and this kind of cash inflows can really improve the balance sheet, especially if they keep focusing on that. I think in 3 to 5 years, this has potential to become a very attractive dividend payer, and by the time they do it, this price can easily triple. But again, that's not for everyone, and the people who own the WBD would rather go for a 3-4% sure dividend now than all this potential in the future. It might be worth it for us, but again, it's not a risk-free investment and it doesn't fit every portfolio. You know, even among the people who buy this, some may go with 20% of the portfolio, others with 10, 5, 3, it's ultimately about the risk and reward you are willing to take. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.